Alrighty, folks, how you guys doing? Do me a favor, just give me a quick indication in the chat window that you can hear me. Looks like everything is working here, but just want to make sure. Everything good? All right, cool. Okay, folks. So anyway, first of all, for those of you who were here last week, thank you very much for attending. I apologize for the technical issues last week. So as a makeup here, what I plan to do is I want to do three things here. Firstly, I'm going to do let's say a 5 or 7 minute review of last week, just to kind of set the stage for actually then starting to construct some positions here. And then what I'm going to do is I'm going to construct a position which for something that I'd already set up here. But then what I would like to do, if you guys would, is punch in a few symbols into the chat room, please. Because what I would like to then do is to kind of grab a couple of symbols and kind of go through the analysis of what one would normally do in terms of kind of shaping up a potential opportunity in terms of buying an option. And so I'd rather kind of take something out of the air that you guys are doing and just kind of approach it that you think of, so that I can just kind of approach it fresh and not be dealing with something that I've already done. So if you would please, in the next couple of minutes, just punch in a couple of symbols into the chat room. Just don't use Alibaba, because that's the example that I'm going to be using. So at any rate, so let me very quickly, in about 5 to 7 minutes, just kind of go through and do a quick review on what went on last week. Basically, we talked about options. We talked about the leverage that they provide and the flexibility that they kind of give us in terms of constructing options, constructing positions. And one can use them for, obviously, for strategies where you have a positional view on something where you're expecting it to go up or down. Then, of course, it also allows you to also construct strategies where you think price is not going to necessarily move much one way or the other, or be constricted by a range. And then, of course, one can also have strategies where you act as the casino in terms of collecting premium from other people that are buying options. But the focus here, of course, is to be able to take a positional view by, and, in a sense, try to, capitalize on a move in a stock by buying options. But there are certain times that it's more advantageous to buy options than others. And so we're going to get into all of that. Okay, so in terms of what we want to have is, you want to start out with options that are highly liquid. You want to basically have options that will tend to move. This is all in the context of actually buying options. So you want to have options that are going to move. You want to have options that are liquid, and the fact that they're liquid means that two things: that you'll be able to get in and out of a trade with relative ease, and then also, if you know anything about how asset prices are priced, basically, as the market makers who are in the business to basically make money in the market, they essentially act as bookies. And so as a result, they essentially create a market. And so they basically sell at the higher price. Okay, and it's up to us as buyers to essentially buy at that higher price. Similarly, when it comes to buying, they buy at the low price, and us as retail traders, we of course sell. We basically get the raw end of the deal on both ends. So consequently, if the gap between those two those two things, which are referred to as the bid and the ask, if that's relatively narrow, that makes our trade a lot easier. And so consequently, by selling things that are highly liquid, that the spread between those two things will be relatively narrow, and as a result, it makes our trade a lot easier, because instead of, if something's very liquid, you may only have to make up a nickel or a dime in the trade in order to sort of then start to make money. But on the other hand, if it's something is not liquid, then you may end up having to make up 20 cents, 30 cents, 50 cents or more. And as a result, the first 50 cents you make on the option, you're basically just giving it back to the market. You're basically just at a break-even point there. So that's the reason that we care about things that are relatively highly liquid. So last time when we met, we kind of talked about what are the key elements that actually basically where does an option's value come from? Okay, and it basically comes from essentially there are three primary, or really four primary things that impact on the value of an option. One is the literal position of the price of the underlying in relation to its strike price. In other words, the contract price in there. And so if you're buying a call at 105 and the price of the stock is at 100, well, then you're $5 out of the money. On the other hand, if you get the 105 call, but the price of the stock is 110, well, then obviously you're $5 in the money. Okay. Then, of course, the other thing that impacts on the value of the option is how much time did you buy? Did you buy 2 weeks, 2 months, 6 months? As you would expect, the more time that you buy, the more you have to pay. The more you will obviously be paying for that time. So that's part of the value of the option. And then the last thing is, and this is sort of the invisible part of the option, and we kind of talked about that, and we'll then kind of go into this now, is the notion of implied volatility. Implied volatility is essentially the invisible, hidden part of the value of an option. And I think last time when we met, we talked about the fact that you can have two stocks, both of which are $100 a share, both of which you're looking at the 105 call, and both of which there is 1 month, let's say 30 days of time left to go. And yet, so they both have, and in terms of their price, they're obviously 5% out of the money, because both of them, the stock is at 105, and the stock is at 100, but the strike price is at 105. So basically, you're talking about 5%. Well, in one case, one option might be worth $1. In another case, the option might be worth $3, even though they both have the identical characteristics. So, in fact, what makes one more highly valued versus the other? Essentially, it ties in with the fact that it ties in with the demand for options, and that demand for options, essentially, like anything else, when demand is higher, it drives prices higher, and so as a result, in the case where there's a great demand for options, that drives the price of those options higher, and that can be calculated. And that's in fact what's referred to as implied volatility. And what it does is you take the price of the option and you do some sort of calculus transformation on it, and you isolate that, and essentially you come up with that number. You don't have to, and I don't have to actually deal with it, as long as you understand what the concept of it means. Okay, so that's the concept of implied volatility. Now, before I'm going to go into implied volatility in a second, but what you're looking at right here is the key part, really the foundation of first putting an options trade together. What you have here is, on the left here is, this was a level that we were looking at where just on the underlying stock, where price came up, kind of consolidated, and then kind of ripped out of there. This is essentially this whole concept that we talked about last time about supply and demand. This was an imbalance got created by an exhaustion of sellers, and when price ripped out of here, it was upward price pressure. So when price returns to this level, we expected price to kind of head out there again. Obviously, they don't all look as pretty as this, but obviously we chose a nice example to kind of really illustrate this point here. So what we do is, in creating an options trade, the first thing we do is we chart the stock. This creates our price action thesis, so that when price returns to a particular level, if things work out, we'll get an expected and anticipated price reaction like we got here. Obviously, we can only pray to God that we would see it work this well. But again, I was just trying to find a really stark example of this. So that's the foundation of the trade. Okay. The next thing that we care about is time value. And we talked about this, again, introduced the concept last time. So again, we have this concept of intrinsic value of an option. That's how far an option is in the money in relation to its strike price. So I was using the example of 105 before, of a 105 call with a $100 stock. So in that case, we're $5 out of the money because price is below the strike price on the call. On the other hand, if it was $110, then we'd be $5 in the money. That's what's referred to as intrinsic value. Okay, so you may have an option that's worth, let's say, $5 in the money, and yet the price of the option is $7. Well, there's $2 extra there. Where does it come from? Well, that's what's referred to as the extrinsic value, and that extrinsic value is essentially made up of time, and then the time is influenced essentially by the implied volatility that I talked about a couple of minutes ago, where again, one time you could have an option that's where 30 days of time is worth $1, and then with another stock, you can have that 30 days of time is worth $3. That's the implied volatility at work. Okay, and the way it works with time value, here's what time value looks like. So when you're, let's say, a bunch of weeks out, and price starts, and then time is eroding, notice that the slope of this is relatively benign. It's relatively flat. And then as price comes down, notice it gets steeper and steeper and steeper until it practically goes vertical at the end. Okay? Well, that's essentially reflects how the time value is coming off of the value of the option. A lot of the options concepts, I'm sure most of you know, they use various Greek letters in order to symbolize them. This is what's as time comes off of the value, you have the time value, but the thing that takes away from the time value, that erodes the value of time, is symbolized by the Greek letter theta. Okay, and the way it works with this is that up here, where the slope of this is relatively flat, price is the value of the time decay is relatively small. As time goes on and you get closer and closer to the expiration date of the option, each day that you're in this trade, if you happen to be now getting down towards the end here, notice that for each day that goes by, you're probably losing a lot of value here. Why? Because the slope of this line is, you can see this thing is running down faster and faster and faster. Up here, it's relatively flat, and so as a result of all of that, the way we look at buying options is that even though you're going to pay more up front, in fact, you want to buy options generally where there's more time left to go, as opposed to buying it with less time to go. Even though, in fact, up here you may pay, let's say $4 for time value up here. Down here, you may only pay like $1.50 or $1. On the other hand, up here, if you're in the trade for 2 weeks, you might only lose, let's say, 30 or 40 cents worth of time value if you buy, let's say, 3 months of time up here. On the other hand, if you buy 3 weeks of time down here, and then 2 weeks go by, you may have paid $1.50 worth of time. You may lose and end up losing like $1.20 worth of it. Where up here, for that same 2 weeks that goes by, you may only lose like 30 or 40 cents. So this maps to life as well as options or assets. It's the concept of value versus cheap. And the way most people go about trading options, they tend to actually gravitate when they buy. They tend to gravitate to the cheap and not to the value. And so you're going to see in about 5 minutes when I actually start to show you an options position here, or in a sense a series of options positions. You're going to see the effect of cheap versus value. Okay, and so that's the concept of theta and time decay. Okay, now right here I'm going to go back to this concept of implied volatility here. And I think I may have shown this briefly last time. It's going to take 2 minutes and just kind of review this again. So again, this is essentially reflecting how much added value gets added into the option because of this concept of implied volatility. And so the way it works here is this chart that, and I have this little application that kind of got built, is basically something that effectively averages out the implied volatility for any particular symbol. So if you're looking at the SPY or Google or Tesla or whatever stock that you're looking at, it will essentially kind of calculate what the average implied volatility is. And the way it works with this is that when implied volatility is very high, you really want to be when it's very high, you really want to be selling options rather than buying them. Why? Because essentially you're buying options when they're more expensive than they are on average. And the other thing about implied volatility is that it has this tendency to regress to the mean. When it's very high, it will tend to come down, and when it's very low, it will tend to come up. Now, what drives that? When we're talking about stocks, there's a there's a series of natural events that happen with stocks, and that's essentially what kind of causes implied volatility to kind of oscillate. And what they are, of course, are earnings announcements. Earnings announcements essentially bring out the two emotions of the market. One which is essentially kind of fear or anxiety, and the other one is anticipation. On the fear side or the anxiety side are people that own a particular stock. It's a long-term holding in their portfolio. They don't necessarily want to sell it, but when the earnings announcement comes up, they're kind of fearful. Why? Because if they happen to come out with a bad number or there's a bad earnings call, the price of the stock is going to get slammed. So what some people will do is, or institutions that are holding these things, is they will essentially buy put options, which allow you to sell at a particular price. And so what they can do is if you sell, let's say you own a stock that's $100, if you buy a 95 put, that gives you the right to sell it at 95. So if for some reason the stock gets slammed down to, let's say, 90 or 87, well then effectively the $13 will get lost on the share price, but once it goes through 95, then the option will start to increase in value. And so as a result, the gain that you get from the option will offset will start to offset the loss in the stock. Okay, and so that's what happens as you start to head towards an earnings announcement. Implied volatility tends to go up, and that drives the price of options up. Once the earnings announcement comes out, then all the air comes out of the balloon. All the emotion comes out of it. Why? Because now the mystery and the fear associated with the upcoming earnings announcement is gone. And so as a result, then the option will then kind of deflate in value very quickly. And so that's what you kind of see in and I'll show this to you in a chart in a couple of minutes. But that's what goes on here. So price of the implied volatility kind of oscillates here. And basically when on the average implied volatility is kind of low like this is the environment that makes it attractive to be an option buyer. This is what when price is way up here, this is the environment where it's attractive to actually selling options. Because down here you could be buying an option with, let's say, 30 days to go, and let's say it's like right at the money. And in one case here, you might pay, I don't know, let's say $2 worth of $2 for that 30 days of time. On the other hand, if you bought the option, that same exact option right here, you might end up paying $4 or $4.50 for that time for the same exact option. in one case you're paying $4 for time, and down here you're paying $2 for time, and the difference is the implied volatility. So again, like a lot of things in life, you'd rather buy low and sell high. Okay, and right here, if when you're in this environment, or even where we are where this chart was right here, at that moment, it would have actually been advantageous to basically be a seller of options, not a buyer. Okay, so I hope that's clear. So that's the major takeaways from the sessions last time. Obviously, we went through a whole lot more stuff, but essentially, though, that's essentially the primary takeaways. So what I'm going to do now is I'm going to actually bring up a chart and start to go through kind of how we sort of prepare an options trade and sort of take you through some of the analysis. And then, like I said, I hope you guys at some point that will punch in a couple of symbols so that we could then kind of look at a couple of symbols kind of live here. So let me pull my platform over here, and we will get at it. Okay, so this is a chart of Alibaba here, and I was actually initially looking at this chart really about there, about a week. In fact, it was precisely a week ago. Right? Today's Thursday. Yeah, I believe it was actually last Thursday that I was looking at this. And at the time when I was looking at it, I realized, okay, right in here there was a level where price came up. Kind of notice it kind of goes sideways here, and then notice it kind of drops out here, and then there's a big gap. Then there's another kind of a big bearish candle here. Notice there's another gap here. Then it actually kind of drops down, and in fact, this is actually a very bullish candle. It came up, but nonetheless, notice that even here on this very bullish move, it still in fact ended up closing significantly below this price. So really, we had this major move down in 1, 2, 3, 4 trading days from here at around 187 or something like that, all the way down to here at 175, and in fact, it actually went as low as 171. So this exhaustion of buyers suggested that, in fact, because price spent a very little amount of time here in this level, there was the expectation when price returned to this level, there would probably be still more downward price pressure. And that essentially would be the basis, the predicate for a bearish trade. And I was kind of looking at, and if I broke this thing down into a smaller time frame, when I looked at kind of a 60-minute chart, and I ended up looking at a half-a-day chart, for various reasons, I came up with the price thesis that it would be advantageous to actually be able to basically be selling at around 187.50. Okay, and so that was essentially kind of roughly at that point. Okay, and that was based on basically what this formation looked like. And then, in fact, if I went back about a year or so, I think there was some also similar price action at roughly that level. So for various reasons, I decided that my bearish trade would be at 187.50. Okay. So what I'm going to do now is I'm going to pop up another screen here, and what we're going to do is we're going to look at a number of different formations or another few possibilities of how to structure an options trade. Now, before I do that, let me just do one quick thing here. And what I'm going to do is I'm going to turn on this tool here. And if you recall, when I showed you this earlier, I remember I showed you this a couple of minutes ago. Okay, well, this is essentially in the chart. Again, remember at the top of this scale was you want to be an options seller. At the bottom, you want to be an options buyer. So right here, this is essentially another version of this. So notice right here, we are sitting at relatively close to the bottom here. Consequently, options on Alibaba in comparison to other months and other time is relatively cheap. And I'm just to give you a little kind of more of a global perspective on this, if we kind of pull this back a little, and in fact what I'm going to do is I'm going to quickly turn on this. And if you notice right here, you see these dots here? All of these dots here, these correspond to the earnings announcements. Okay, and if you notice, what I'm going to do is I'm going to throw in these lines here. And I'll move this line over to that one. And where's the last one there? And if we look at this, and what I'm going to do is now I'm going to kind of move this up a little. So you can see these lines are where the implied volatility is. And if you notice, notice leading into these implied volatility, which is the red line here. Notice as we start to head towards these earnings announcement dates, and these are not, okay, notice as you head towards it, price kind of goes up, the implied volatility goes up. Well, all of these upward moves in implied volatility, the red line, this is essentially driving up the price of options. So you could have, again, the exact same option, and yet they're becoming more and more expensive, even though the characteristics of the option have not changed. Okay, and certain options for whatever reason, like an Alibaba's, I guess because it's a foreign company, a lot of times these act slightly differently. If you notice, a lot of times the implied volatility peaks right before the earnings announcement. I think part of it has to do with literally the calendar, is that it's one day ahead. But then there's also, I think they release some information ahead of time. I'm not exactly sure, but if you notice, it kind of seems to peak. But notice once the earnings announcement comes out, particularly right here, notice that it kind of comes crashing down. Notice right here, it kind of was up. It went up a bit afterwards, because a lot of times they'll say something in the earnings call that might still create a little mystery. But basically, once the earnings announcement comes out, implied volatility goes down. Notice the earnings announcement is out, it comes down, and it stays down there until it starts to crest again. Similarly, right here, the announcement came out, and again, right here it came out, and then again it drove down here. So you can see there's definitely a cycle that goes on here, and so as a result, as options traders, we want to take advantage of that. So right here, this is where I looked at this and I said, okay, it's reasonable to be a buyer of options here, because we're not. On the other hand, if I was looking up here, then I certainly would not be buying. But since I know how to sell options, I would have been looking at an option selling strategy. For the purpose of our discussion today, we're going to be focusing obviously on things where it makes sense for us to be options buyers. Okay, so what we're looking at here now is that same exact chart, and again, so right here. Here's the criteria of how we kind of build an options trade. We start out with the underlying chart, and we're looking for what we refer to as the supply and demand zones. Okay, and this is this area of downward price pressure, where essentially you had supply of shares that was there, and then the demand for these shares at this price just disappeared. That's what drove the price down here. So since you have supply and demand at equilibrium here, and then all of a sudden the demand disappears, well, if this zone previously had supply and demand in here, and then the demand just disappears, this is why we call this a supply zone. Why? Because the demand is gone. Okay, down here where price kind of went sideways here and then popped up like this, I'll just circle this area here just as a means of comparison. When price came down here, it kind of went sideways here, and then notice there's that gap and price kind of rocketed out of there. Well, right here, the supply of shares disappeared, and that's why essentially the buyers ran up the price chart. So not surprise, surprise, if we call this a supply zone here, this is what we would call a demand zone down here. Okay, so that's the first part of the options criteria. We basically look at the underlying chart. we look at the supply and demand zones, and essentially what we just say is, okay, how would I trade this stock? Forgetting the options, what would I do if I was just going to basically just buy or sell stock? And so the way I would buy it, the way I would look at this, and so if you recall, I said I was looking at this on April 4th. So this is when I was reviewing this chart, which was about here. And so my price action thesis on this was that when price came back to this level, I was expecting to see some sort of downward move. And you can see, obviously, when it came up, it kind of tested the level a little, but then it actually started to, and now since then, it actually has started to roll over here. So anyway, but that was the initial part of this. So again, I'm looking at the underlying chart. Okay, come up with the supply and demand thesis on this. So we went through this. Then the next part of it is, if I'm looking at this chart and I say, okay, if I'm looking for this thing to have a downward move, well then how far down could it go? And the one thing I just don't want to see is, I don't want to see a sort of a wall that gets created under here. So in other words, I don't want to see anything, let's say, that looks like this. And the reason I would not want to see this is because essentially, if in fact if this sort of formation was sitting underneath here, that would imply that in fact when price comes down and kind of hits there, that might be the end of the line there, because this would essentially act as a little demand zone, and so price would then pop out of here, and so effectively price would not come down very much, and so as a result this trade would not move enough, and then this would probably not turn out to be a successful trade. But fortunately, and this is why I was okay with getting into this trade, is the fact that nothing like that formed. There's really no barrier here. And so if things go according to plan, then price has a reasonable shot at kind of coming down, let's say down to at least 180, 178, somewhere in there. And if that happens, this will turn out to be a highly successful trade. Okay, so if you recall from when we talked about, when I introduced the concept of time decay, I said in fact you don't want to be buying things with very little time. Okay, because of the fact that time decay tends to be very rapid in that case. So, but what I did though is, as a sample, in fact, I did set up something here where, in fact, I basically set this up with the way a typical option buyer who is buying puts. A lot of times, this is the way a lot of options buyers will tend to look at this. They're going to go, okay, let me buy this relatively cheap. So I'm going to buy it out, let's say 2 or 3 weeks out in time. So you can see today's the 11th. So right now this thing has got 15 days left to go, and I actually got into this trade about 2 or 3 days ago. So at the time it had about 18 days to go. So this is the way a lot of options buyers tend to like to do this, and then you also tend to buy them out of the money. Why? Because again, they're cheap, and you can see this option. And then, so this is the symbols that I use. Plus P means you're buying a put. Okay, and this was buying the April 26th put that expires April 26th. Okay, it was at the 180 strike price on the put, and it cost about $1.40. Okay, on the other hand, right here, okay, something which you were going to buy that's going to expire in about 6 weeks or 5 weeks. That's 6 weeks, yeah. And that was actually basically about $5 in the money here. You can see this cost $11, okay, versus $1.40. Okay, so this is basically a multiple of what? About 8. This is about 8 times this. On the other hand, which option is going to do better in terms of making money? This one, the $11 one. Why? Because you have a lot more time to go, and consequently the time decay is going to be much more benign. You're only going to lose a few pennies, let's say if you're in the trade for 2 weeks, and the fact that you're actually running to bring the Greeks into play, you're running on a higher delta, so that if the trade goes right, you're going to capture more of the move than something like this, on the on something that's, let's say, $5 or $7 out of the money. And I'll start to show this to you in an options platform in about 2 minutes here. So this is one structure of what we could do. You could either buy an option that's, let's say, somewhat in the money with a bunch with some reasonable amount of time. And here's another one where I actually was running an experiment and actually buying this 2 months into the future and even 3 months into the future. Because again, we don't know how long we're going to be in this trade. My crystal ball is still in the shop, and it's been in the shop for 57 years. So I cannot predict how long I'm going to be in this trade. You know, so far I've been in this trade, I think, about 3 or 4 days here. But I really have no idea how long this trade's going to go on. It could drop like this, and I could be out of this trade in 2 or 3 days. On the other hand, I might find myself in this trade for 2 or 3 weeks. I really don't know. But having having more time that's not going to basically degrade on me quickly is the way to go on this, at least in my opinion, and the way we trade here at PTL when it comes to options. Another way to structure this trade is, rather than just buying a put like this, notice right here we have kind of a dual a dual trade, which actually has 2 components. So right here we've actually done the same thing here, where again I bought this put, okay, but notice now underneath, okay, I then sold a put. And incidentally, I just want just to let you know, you'll see some of these things here are circled, and then some of them are just kind of hanging out here in white space. All the all the ones that are circled here, these are all individual, just buying a put with various strike prices and various expiration dates. Okay, so this is a separate trade. This is buying a put, that's buying a single put, that's buying a single put, and that's buying a single put. Over here, we have a cluster where these are all what are referred to as bear put spreads. Okay, and what that means is that we've in fact bought one put, okay, and then we've sold another put underneath to reduce the cost and change the characteristics of the trade. So what we have here, if you notice that there are all these prices that are here, $11, $6.70, $6.50, etc. These were the prices of all of these options when the trade entry was achieved 2 or 3 days ago. Okay, so when I got into the trade, I believe it was on the 8th. Okay, these were the prices for these individual options and for these puts. So in this particular case, this put was $11, and yet this one I only paid $6.70 for the bear put spread. Okay, so what that essentially means is that I sold this put down here. Was worth approximately $4.30, because if you take $11, subtract $4.30 out of it, you're going to get left with that net debit, that net cost of $6.70. Okay, so that's what these numbers signify. These were the costs. Okay, similarly right here, this is something that was going to expire roughly in about a month. Okay, and basically what I did was I sold, basically bought a put a little further down at 190 versus 192.50. So this put was not as far in the money as it was here, where it was about $5 in the money. This one was basically about $2 in the money. And so what I did was I sold this one, and then one could then buy this one and then sell this one underneath. And again, you can see that on a net cost basis, this was actually relatively the same. Okay, so what you're doing is you're basically paying more for time. Okay, but because we are not as far in the money, that reduced the cost. Okay, because otherwise up here, if we would have done the same exact structure of the 192.50 and the 177.50, and we did it just for 1 month out, then in fact this would have been a lot more expensive. This might have been like $8.70 or something like that. Or $8.70, $9 and a quarter, something like that. But since this essentially, we bought more time, but we actually then bought it further, not as far in the money, and so the two of them actually compensated for that. And then here's a couple of other different structures here. Okay, All right, so what I'm going to do now is I'm going to bring up the options platform, and I'm going to kind of show you, in a sense, how some of this stuff, how effectively one can effectively compare one scenario versus the other, and how, in a sense, some of the concepts that I went through earlier start to come into play in terms of value versus cheap, how buying more time is better than generally than having more time is better than having very little time, like 2 or 3 weeks. Even though, again, we showed earlier that one option cost about $1.40, another one, and then let's say those spreads that I just did cost about $6 and six and change. So that's about 4 or 5 times the cost. And yet spending more is far more beneficial than trying to do this cheaply. So what I'm going to do here is I'm going to first show you, kind of like I said, right here, this is a very typical scenario, because in fact I actually spoke to a couple of novice options traders when I put this thing together a couple of days ago, and in fact I sent them this chart. And I said to them, I said, look, if you were going to buy, if I told you that I expected the price of Alibaba to kind of drop from here, and I said, okay, I'm going to get into the trade at about 187, what would you do? And this is what the two of them, this is what two of them told me here. Okay. So one of them said, okay, I'm going to buy I would buy the 180 put, and that would cost, and so and that expires on the 26th. So that's again in about 2 weeks. So that's about $1.40. And again, this was one that had more time, but further out of the money. But nonetheless, because you're paying for more time, about what is that? About 2 weeks here. It turned out that this thing was going to cost about $2.40. Okay, so this is what, like I said, a couple of novice options traders, this is what they told me that they would do. So I threw this in here as well. So what I have here is, let's see here. Let's look at the one where it's April 20th. Okay, so it expires on April 26th, and it's the 180 put. So that is this one right here. So you see it says single, and you see it says 180, and there's April 26th, and there's the put. So that's this scenario right here. And so the way one can look at this is the options platform. This is what's referred to as the P&L analysis tool. Up here is a graph. I'm not going to use the graphs here, because in fact it's much easier and more effective to actually show it to you, show you the stuff kind of numerically. Okay. So what I'm going to do here is this, and this is one of the skills that as an options trader you really want to develop, is to basically figure out how to drive this platform, because essentially there is a wealth of information that this tool will give you, and essentially, like anything else in life, there is a learning curve to it. Obviously, but once you kind of master it, like I said, the amount of information that this thing gives you really allows you then to make some really intelligent decisions about your about an options scenario. So here's the April 26th 180 put here. And so what I'm going to do is, the way it works is that when you have a bunch of scenarios here, what you have to do is just check off the one that you care about, and then above that will kind of give you the information that you need. Okay, so what I'm doing here is I check this thing off. Okay, first of all, let me just go back and review oops, hang on one second, folks. There we go. Okay, so what I'm going to do is I want to go and check to see what the price was. Okay, so the price of what this was valued at the time was $1.40. Okay. Okay, so right now this is telling you that this thing is worth basically about $1.60 now. So this thing has picked up about 20 cents in value. And the reason that this option picked up 20 cents in value is that from the point that I got into the trade, whereas I didn't get into this trade, of course, I didn't do this, but had one gotten into this trade, they would have gotten in at the same, I ran the calculation here, at 187. And so when they got into this trade, they would have paid about $1.40, okay? So at the time they would have gotten into this trade, they would have paid about $1.40 for this option, okay? So what I'm going to do now, and this is the cool thing about this tool, is that what we're looking at here are what are referred to as price slices. And so what this is doing is I have inputted all kinds of various prices, and by inputting these various prices here, that allows me to then start to compare what the price of the option is going to be. Hang on one second here. Just give me 1 second here. Hang on, folks. 1 second, please. Hey folks, I don't know who, I have everybody, at least visually. It looks like everybody's self-muted here, and yet I'm getting some microphone noise from somebody. Could you guys just check your microphones? And whoever, if your microphone is active, can you just put it on mute, please? Wait, there it is. Thank you. Okay. All right. So anyway, so this thing cost about $1.62. Oh, excuse me, $1.40, and now it's worth about $1.62. But let me show you the implications now of how we can use this. So here is where we got into the trade at $187. Okay, and what I did was I set up various sample prices for Alibaba to fall, and then notice this 188.50, which is up above. Well, this right here is the point where I would have said if price came up to 188.50, this is where I get stopped out of the trade, because of the fact that at that point that would mean that my price action thesis kind of obviously failed at this point. We can see that it didn't fail. It kind of flirted with it. It kind of came up a bit. Then eventually it did start to kind of drop out of here. But had this thing actually reached 188.50, I would have gotten stopped out of this trade, because essentially, again, that's where my price action thesis gets blown up. In fact, my partner, Ryan Nocera here, he's got a very good expression about this, which is what he refers to that is that you've lost control of the trade. You had a price action thesis, you had a plan, everything was predicated on that there was going to be a downward price pressure, and yet when it went up into the level, if it just kind of basically rips through like this, well, at that point, you've now lost control of the trade, because essentially your whole price action thesis got blown up. And so at that point, as disciplined traders, we are taught to just kind of admit that we're wrong and to move on. So that's the purpose of having in here the 188.50 here. So what this is telling us here is that this is what the price of the option would be at various price levels. Okay, and so so right here, here's where you are. You see where it says last here? That's the $1.61 that we're looking at. And the reason this says 161 here, of course, is that each option controls 100 shares. Okay, so consequently, $1.61 or $1.62 times 100 will of course give you $161. Okay, so this is a $4. So what this is telling you here is, as of this moment, if price would actually come to any of these numbers here, this is what the option would actually be worth. Okay, so if you recall, we paid $1.40 for this option. Okay, so right now, again, we're up about 20 cents on this. So, but here's the powerful part of the platform here. Had one bought this, okay, this is the expiration date, and you can see it says DTE 0 here. That means that there's 0 days till expiration. So this is the end of the line on this trade. But then you notice that I got this one down here, this green one, and so I put this third one here because this is the end of the line on the trade. But this is one where I can essentially sort of I'm going to change these dates in order to then see what is this option going to be worth at a particular price on a particular date. So let's say that I'm in this option, okay, and again, it started to work. I've been in this option. This trade has now been ongoing for 3 days, okay, and let's just say that price kind of stalls out a little, or maybe even goes down another dollar. But let's now say that when I'm in this option, I don't know, let's say I'm in this for another, let's say 10 days, and that would take me up to April 21st, okay? So if I move this slider here, that takes me right there to April 21st, okay? All right, so now if you recall, we paid $1.40 for this option. Okay, right now it's worth $1.61 or $1.62. Now watch what happens to the value of this option if, let's say, price doesn't really move a whole lot from here, or even let's just say even it drops a little more. Let's say it drops to $1.84. Okay, so which means right now, if it had dropped to $1.84 today, it would be worth approximately $1.92 right now. Okay, watch what happens now though if 10 days pass. So this thing went down about another dollar, a little over a dollar. So watch what happens now when I change this to plot 3. Okay, and so as a result, it'll now reflect what the price would be anticipated on April 21st here. Bang. So now all of a sudden, this thing, okay, if it was worth about $1, what did I say? What did I say? If it was worth about $1.92 today, if 10 days pass on this option that has a relatively short duration, it's going to be worth 72 cents. So it'll be worth $1.20 less than it is today, and it'll be half of what it was worth when we bought it. Because if you recall, the purchase price for this option was $1.40. So it's basically it's anticipated to be worth about half of what it is of what it was we paid for it. Okay. Now let me show you in comparison. Looking at, let's just say, a longer term option, like right here, that expires on May 24th versus April, I guess it was April 24th or April 26th, whatever it was. Okay, so here's one. So, it's an expensive option. It was worth $1.92, and one would have paid about $11 for this one. So what I'm going to do is I'm going to go back now, and I'm going to turn on this one. So what I'm going to do is I'm going to unclick. I guess I already did that, right? Yes. All right. So I already did that. So let me go back now, and I'm going to turn on this one that's worth. Here's the 192.50, May 24th. And so what I'm going to do is I'm going to click on that one, and so that turns this one on. Okay. So again, we paid 11. So one would have paid $11 for this 3 days ago. Okay. So right now. Okay, so here's where we are right now. It's now worth When I say it was worth 10, it was worth $11 even. Okay, so now it's worth 11.80 because prices, price has dropped about $2.50, which were about $3 or so, or $2. So we basically picked up about 80 cents of value here on the value of this option. Okay, so that's what it's worth today. But here's the point of what I want to show you here. Remember before I showed you, okay, so here's what it would be worth if it was actually fell to $1.84. Okay, this is the one that we looked at before on the one that expires very soon. Remember we saw that it was only going to be worth about 72 cents before. Okay, so right here we picked up right here, in fact, at this moment, if price had dropped further today and it dropped to 184, it would be worth about $12.50. So one would have picked up about $1.50 of value if it was worth if that happened today. So I'm going to show you now the same thing. I'm going to have 10 days pass, and so what I'm going to do again is I'm going to set this green line so that it now shows that 10 days passed, and I'm going to go from April 11th again to April 21st on this one again. So it's the same exact thing that I did before. So here is April 21st. Whoops. Let's try that again. All right, for some reason it doesn't want to hold. It's only a 1 day difference here, but I don't want to waste time trying to. Every once in a while that tool gets finicky here. So there is a 1 day difference here. Okay, but notice right here now. Okay, so this is what this option is worth today. It's worth $12.52. Okay, watch what happens when I change this to bot 3. Okay. It's now worth, let me see, whoops, did I get the right one there? Let's see. Right, 12.52. Okay, as a percentage of this price here, we've lost, okay, in fact, this is still not a great trade, okay, and this is the reason why I didn't even pick this, structure, because of the fact that you're still losing a fair amount of time value on this, even for this, even for giving this amount of time. But here's where the sweet spot on this trade actually comes up, is rather than buying a straight put, okay, what I in fact did was, in fact, I basically sold one of these here. Basically, excuse me, I bought a put option here, and I bought a couple of different ones here. And so what I did was I bought one here, I sold one here, and then I also bought this other one and sold this other one. So let me show you how on these scenarios how this compares. So this next one is, let's see here. All right, so this is the one that expires on June 21st. And it's the 190 by 175. So here's the June 21st. Here's the 190 by 175. So let me make sure everything is on click there. And so what I'm going to do now is I'm going to activate this scenario here. And you're going to see that this essentially becomes a much more, what I characterize this as a much more forgiving trade. Because essentially this is going to allow me to essentially kind of stay a lot longer in the trade, because the time decay on this will be much more benign. And so again, let me just go back. So on the price that I paid for this one, which was, let's see right here, was $6.50. Okay, so right now it's picked up about 20 cents. So it's just starting to kind of kick in here. Okay, Okay, but the point being is that if it, let's say it came down to here, well, then it would be worth about 695. And notice now if I change this again to the April 21st, and you can see this is now worth about $7. Oops. Notice it's barely changed at all, even though 2 weeks has now passed. Okay, this was basically 695 before, and it's basically almost, so really at this point there is virtually no time decay that has come off of this trade. And that's the thing that I really like about doing these debit spreads here, is that this thing effectively buys you time for this trade to work. So that it then, let's say, if we want to give this, let's say it needs some more time to get down to, let's say 182. Okay, now all of a sudden, now it's up to 740. Okay, but notice that effectively before, here is where, okay, notice that from 740, 744, and now I change it. In fact, it actually even went up a couple of pennies. There is really no time decay that's coming off of this thing, and that's the point of kind of why by doing these debit spreads are really nice, is that it really kind of crushes the amount of time decay that comes out of it. So what you're doing here is you're basically having a slower developing profit, but you're not getting crushed by the time decay that I showed to you before, where it was basically at, where it got sliced in half in that 10 days. Because essentially, if you knew that price was going to basically drop really fast, well, then you would just buy a put, and you'd buy it with enough time, and at that point, things would just go right. And you would, essentially you would pick up a fair amount of the move in the stock. But because of the fact that you're buying one option and you're selling another option, notice here, this is the delta, okay? And this is the amount of how much the next dollar move in the stock you would pick up in the value of the option. You can see here you basically would pick up about a quarter each time, okay? On the other hand, if you were basically just doing a straight put, then let me see here, which is the 192.50 right here. Notice right here, you're picking up a significant amount more on a per dollar basis. But the problem here is that you're also, if you would get stopped out of this trade, you would also lose a lot more. Let's say if in 3 weeks. So before, remember I showed you that we spent, let me see, what did we spend for this particular option here? We spent about, on the 192, we spent about where is it? Okay, we spent $11 on this one. Okay, and notice if we got stopped out in 3 weeks, this thing would lose close to about $1.70 in value. On the other hand, with the vertical, where I'm basically kind of where I bought one and I sold another one, if we get stopped out, okay, then basically we're only losing basically about let's see, where do we pay? We paid about $6.50, I think. We're losing about 35 cents here. So that's the power of utilizing these spreads, because of the fact that it cushions the trade, and it allows you to still profit, and in fact it buys you more time to stay in the trade, and sort of just let things develop. But and in the same token, it cushions the time decay on you. And so that's one of the things that we're fans of here. It's kind of tough to kind of convey all of this in a webinar and try to kind of shuffle between, various screens on this. But I hope, at least as an introduction, that will, kind of help to give you a flavor for, kind of what what one can do with these things, because of the fact that essentially we don't live in a perfect world. And so one of the things that we do when we build an options position is kind of build in either time for things to go wrong, or essentially to kind of give us the cushion so that when things are not necessarily moving rapidly, we still don't get crushed by the time decay. And like I said, I think that, and I thought a very stark example of this is the difference of how one gets stopped out of this trade, where one basically takes on, a relatively small amount of pain versus a much larger loss. But anyway, so what we're going to do is we will send to you we're going to send to you the PowerPoint of kind of what we just went through here. I will also send to you a couple of examples where I can kind of really highlight these things, and I'll kind of annotate it and I'll send it to you. Essentially that kind of goes through the same scenario here. Okay. So anyway, I'm going to hand this over to Ryan here, and Ryan will leave you with a couple of words here, and I will see you guys soon. Hang on a second.
Muted. Hey guys, sorry we went silent there. Can I just do a sound check? Can you throw something in there? Sorry, guys. When we did the handoff, I actually was talking for like a good 2 minutes and didn't even realize. Sorry about that. Anyway, I asked you guys, I was doing the description of the service, but before I get into that, I wanted to make sure everybody, number one, got a lot out of, thank you. I got a lot out of Mitch's presentation, but, I also at the same point, we know, trading in general, but options especially can be like drinking out of a fire hose, right? So what I was saying is, and I was just having this conversation with a newer student, is that the way to go about this is in like a step-by-step fashion where, you get certain things hand delivered to you and, something that's easy to follow. So I put up the slide for our done for you option service, right? And as I was talking to myself, obviously, but for our done for you option service, that we deliver completely spelled out option setups that include single long options and vertical debit spreads. And they're based on the entire criteria that you saw tonight, right? They're only done on liquid stocks and ETFs that are very liquid. They also have to have enough price movement to raise the probability of success. They'll be done with the same implied volatility values, right, for buying options, right? So we'll identify trade entry prices where the stock price is expected to move in the right direction. We'll document the risk and reward for the different price levels and the duration. All of the trade setups and alerts and updates will be delivered via our online chat room, right? So besides the delivery, it's a nice community, right? We can all kind of bounce ideas off of each other. You can talk. We'll talk about the day's market action, that kind of stuff. I kind of find it's a really good accountability feature too, because if you're not in there, people asking questions and stuff, it kind of forces you to kind of come in there. And we're doing that for the delivery. Just for this, you'll see the price right there on the top at $347. I will be sending you a discount for that if you sign up by Monday. So tomorrow's email, you'll have the whole weekend to think of it, and you just got to sign up by Monday night, and I'm gonna knock $50 off that. It'll be $297 for the month, right? Now, besides that, we have something that's a little bit more in depth for the person who wants to learn options little by little. And it comes with all the features of the done for you service, but this is what I call the look over our shoulder setup service. And it comes with instructional videos that take you from start to finish through creation process for the setups that we send to you, right? It's a easier way to learn, I find, and it's the basis for strategy selections for long puts and calls and debit spreads. You'll get the chart analysis of the stock price action for the projected price direction, price action charts for other symbols that represent future options trade candidates, and we'll okay, better. Sorry guys, I lost the volume again. All right, awesome. Sorry about that. And so as I was saying about the look over shoulder service, we'll do all the price action charts for all the symbols that represent future options, trade candidates with likely entry points spelled out. We'll do the options pricing and risk reward analysis. We'll do the what if scenarios, which is super cool that Mitch was kind of doing at the end of his presentation. The trade duration and exit tactics, just a ton of cool stuff. Instructions and tips for using your options platform and the different tools that come with it. And this is really cool. The monthly office hours, that's going to give you an opportunity to come and ask your questions. Very nice. I'm glad you love spreads. That's our favorite. Yeah, it's our favorite. The monthly office hours really gives you a chance to kind of bring setups to us and let us take them apart. And you really find, or I find, you really learn a lot by just coming and bringing a setup and saying, hey, what do you think of this? And letting us kind of just take it apart. You know, Mitch can really kind of go nuts with that. I'm sure some of you have seen that already. Yeah, so that's kind of the gist of everything. I will not be sending you this out tonight. I will send you tomorrow morning or tomorrow afternoon probably. I'll send you the recording of the webinar, so I'll have that for yourself. and I'm going to send you a link where you can get the service and subscribe. And we'll start sending you setups next week if you subscribe over the weekend. But you'll have also, I have a discount for this also. You'll see this is normally $5.97 a month. I'm actually going to knock off $100 on this. It's going to be $4.97 a month. With that, you have to join by Monday evening. Okay, we have too many people and too many people to deal with to kind of keep this discount running for a long period of time. So if you want the expanded version for $4.97, the same with the other one, the discount's only available till Monday evening. Okay, I will put all that in the email to you in the description of the service. Plus, I'll send you a link where you can purchase it, and after you purchase, you'll get all the information on how to access the trades, how to communicate with us, all that good stuff. And if you have any questions, feel free to throw them in the chat, and I'd be happy to answer. I'm going to hang on for maybe like 2 more minutes, see if we have any questions about either some option stuff or about the service, and I'm happy to answer them. This come with the community. Hold on. This also come with that community area you were speaking about before. Yeah, actually, both services you'll get access to the trading community. The chat room, you'll have a community feature where you can ask questions. We it's all general, and pose questions about stocks, options, all that good stuff. The day's actions, the day's news. We're kind of pretty active in there. Most of the day, don't ask questions and expect a response instantly, but we're pretty active in there. And both services come with the chat room and the trader community. And yeah, it's just awesome. Are you guys going to do a setup on one of the symbols that we gave earlier? Byron, I did not see a setup, a symbol from you. Why don't you throw it back in here? What was the symbol you wanted to see? And you would like to know that too. Yeah, Byron asked about IBM, Mitch. You got it. You can take it. Yep.
unmuted.
How's that, folks? Are we good? Can you hear?
Say it again.
Testing, testing, testing. We're good? Okay. Sorry, folks. Okay, so at any rate, here's the chart of IBM. IBM got crushed at the beginning of the year, through the end of this year, at the end of last year. Basically, like a lot of things this year, has now been on a kind of roughly on a tear, pretty much as the new year began. Here's the low that a lot of things hit on Christmas Eve, and so obviously we've now been kind of in a move ever since then. So in terms of, though, looking at a potential options play, the first thing I would do, of course, is, as I showed before, is I would look to see where are we with respect to the environment to actually sell options, and let's just see if it's, in fact, if it's worth our while to actually be in. Look at an options play in terms of being a buyer here. So let's just, got to throw in the indicator here, sorry. Okay, well, if you recall, remember the thing that I showed you guys before? You can see options are very, very, very expensive here. We're basically sitting right at the top of the level here. So in fact, what this is telling me is that if I was going to do any sort of options play, I would really be better off being a seller here, because essentially the options here are very expensive. Now let me just see if there's probably there could be a reason for that, and let's just take a really quick look here. So what I'm going to do is I'm just going to find IBM here. I just want to see when its earnings announcement is, and there's IBM, and its earnings announcement is 5 days from today. It's on April 16th. That's why these options are very, very, very expensive. So consequently, I would not be looking to be a buyer of options here. On the other hand, being a seller of options would probably be kind of cool. However, we're not. That's obviously not the focus here. Sorry, where? There we go. God, why is this doing this to me? All right, let me just change this one here. So since we know that options are very expensive here, like I said, I wouldn't want to be a buyer of options. I would prefer to be a seller. So in fact, I would look to another symbol, since we're talking about buying options here. However, just to let you know though, if in fact I was going to be doing anything with an options position, I would probably be looking at that level here. So in fact, what I would probably be looking for IBM to do would be to kind of continue its little rally up here, and really probably right at that point at around 147 in this range here, I would expect there to be some downward price pressure, and I would probably take some sort of bearish position, expressing a trade on IBM with some sort of bearish position. But like I said, whatever position I would do, I would actually, in fact, prefer to be a seller of options, not a buyer, because of the fact of what I just showed you. The fact that we're sitting pretty much at that upper end of that implied volatility range, and so as a result, I would in fact want to be again selling options. In fact, one of the things that we would do is in the stuff that Ryan, in terms of the services that Ryan was describing here. In fact, what I have here are I'm going to show you something here. What one can do is, in fact, help isolate basically where options are cheap versus expensive. there are various kind of scans that one can do. And in fact, so this is one of the things that in fact we will be bringing to the service, where we would actually be able to do a scan and kind of narrow down the universe of symbols where one might want to be a seller of options versus a buyer, and then kind of use that as the predicate for a particular scenario here. So let me just bring up something, in fact, where in fact one would want to basically be a buyer of let's say a buyer of options. Let's see here. Oh, let's try. And I'm not going to go through the entire analysis here, but hey, all right. Actually, here's something. So here's McDonald's. Okay. And if we just kind of again pop in that kind of turn on that indicator here. So you can see that McDonald's is actually sitting kind of near the bottom, not at the bottom, but near the bottom. And so in fact, where it's sitting right here, this is actually something where we would actually probably want to be doing. We could certainly be reasonably be a buyer of options, be a net buyer of options, but in fact actually do probably one of those that vertical spread that I had mentioned before. And in this case, what I would probably be looking to do is to actually be looking for a pullback in order to then take a bullish position here. This basically, kind of made a low. There's a high. Now it's made a higher low. It's now made a higher high. So in terms of the old school kind of definition of uptrend versus downtrend, this is certainly in an uptrend. It just, again, made a higher high. And so what I would then be looking to do would be to find a level in here in order to look for a pullback, in order to then find some place where I could then get long. And I would probably be looking at probably this level right here. So I'd have to be a little patient, wait for price to return here. But if you notice right here, price comes down right here. Notice price is in this level for a relatively short amount of time, and then notice this huge run of green candles here that comes firing out of here, and kind of that $5 move that came out. So what I would be looking to do is to have price return to this level in order to then look for some kind of bullish position to go long here with options. And what I would do is then, this is what is referred to as a bull call spread. And so what we would essentially do is we would be looking to buy a call somewhere, probably buy a call somewhere in this vicinity right around here, and then we would basically sell a call somewhere around here. And so what I would do then is I would pop up the options platform, and let's just see what options are available. So we have the May 17th, that's with 35 days to go, but in fact we have to wait for price to pull back here, so that's going to take some time. And then, and again, one of the things that I mentioned when we did the presentation last time, and I'll say this here again, is that we don't want to be in a long position with options as we start to get to those points where time decay really starts to eat away at the trade. And that tends to be more or less really, once you get to, let's say, under 45 or 40 days, that's when it really starts to accelerate. And then, of course, once you get down to like 20 days, then it's just, kind of insane. Unless things just go perfectly right, it generally is just not a good idea. So I would probably be looking, at least initially, at buying June 20, the ones that expire June 21st, because that would give price maybe 10 or 12 days. If it's going to pull back, it'll give it some time to pull back, and then we could still be in the trade for a couple of weeks and not really get hurt by time decay. So in fact, if we do that here, so again, looking at the level here, let's see, about 182. So let me see what we have available here on these options. All right, so these are incremented in $5 intervals. So in fact, we would end up buying the 180. So that's the one we would buy. So we would pay about $1. So what is that? That's about $11.70. So that's what the single, of course, is going to cost. And then what we would do is then sell on top an option, and I would probably, as a guess, I would probably end up selling the 190. And if I sold the 190, that would bring in about $4.90. So effectively, you would end up cutting the, so basically I'd be paying about $11.50, $11.60 for, as price now stands, pay about $11.60. Okay, I would then take in about $5 a premium, which of course would mean that my net outlay would be about $6.60. And so if I now slam these two options together, there you go. So now we have this combined position, and at that point I'm running a delta of about 26, and that's sort of within the kind of the guidelines that's acceptable for a debit spread of this sort. So at that point, so now let me kind of just let me quickly set this up here so that it's accurate. Bear with me 1 second here. Okay, so we're going to buy the 180, and we're going to sell the 190. Okay, so that's essentially what the trade looks like. So we're buying this call. We're going to sell this call. So that's what the trade looks like. And then in terms of our analysis, I would probably, the trade would kind of look roughly about like this. You know, I'm just doing an approximation here. So let's just say our entry would be, let's say around, oh, I don't know, let's say 183.25. All right, so that's close enough. And I would probably put the stop at around, oh, I don't know, let's just say around, well, I guess around 182. So basically, so the trade has about $1.30 of kind of wiggle room in terms of the size of the zone. So if we're going to get in at 183, what do I say, 183.25, and we're going to get at, and then I think we're going to get stopped at approximately 182 if it doesn't go well. And then let's say but in fact, if this thing started to move and it got up to, let's say, 185.50, excuse me, let's say around 180, yeah, I guess about 185.50 or 186 would be a reasonable target here. So you get about a $2.50 or $3 move. So let's just say I set this up at 186. So here's where we are today. So here is the, so when this thing actually pulls back now, because here's the, and let me show this to you here, and this is the where you have to sort of realize something here. Right now, this thing is worth $6.60, but that's because it's much further in the money because the price is significantly higher, right? Okay, this thing is way up here at 188. We're looking for a $5 pullback, okay? So when this thing actually gets back to 183.25, all of a sudden this becomes now, it becomes significant, you know, a fair amount cheaper, because now all of a sudden where it's worth $6.60 now, it'll basically be worth approximately $5 when it pulls back. Now, this, if it takes 3 or 4 days to pull back, then this thing will become probably just a little cheaper, because let's say a week or so of time decay will come off. But again, we're just trying to initially just come up with an approximation. Okay, so if I get in at 183 and a quarter, if we got stopped out on that day, okay, we would end up losing about 40 cents here, because it would go from 505 down to 468. Okay. On the other hand, let's say we'll use that 10-day scenario that we were looking at before, although frankly, for a $3 or $4 move, you probably don't need it. But to some degree, if you're going to look at an options play from the perspective of being a buyer, in a sense, I don't mean you don't want to be gloom and doom, but on the same token, you really want to say to yourself, okay, what if this thing takes a long time? Because the longer the trade goes on, essentially you are going to have some time decay hurt you. And so in fact, generally, you're better off getting stopped out immediately than getting stopped out like 2 weeks from now. It's kind of like pulling off a Band-Aid. You'd much rather just rip the Band-Aid off than have it kind of be, this slow torture. Well, it's the same thing when you're long options. If you knew you were going to get stopped out, you're better off getting stopped out in 2 days rather than 3 weeks. But at any rate, if you got in at 505 and then you got stopped out the next day or that day, you'd lose about 40 cents. But watch what happens if you happen to be in the trade for 10 days. Okay, so this is about 468 now. So if I change this thing now to plot 3, then it goes down. And if you notice, it only goes down about a dime. And the reason that this thing only goes down a dime is because there's a lot of time that we built into this trade, because this thing expires on June 19th. Okay, so now we would only lose about 55 cents. Okay, and even if we get into the trade in 2 weeks or so, the fact that we have a lot of time left is still going to be, it would still be very benevolent in terms of the time decay. Now, on the other hand, if we get up to our target, let's say of 186, well, then we would make about 80 cents. Okay, and even if let's say it took us 10 days to do that, okay, notice that there's almost no time decay, because what's happening here is that we bought a whole lot of time, and then the debit helped to cushion the time decay. So at the very beginning, when we're high on that curve that I showed to you at the very beginning of this presentation, this thing really helps to kind of keep the time decay down. Now, on the other hand, let me just show you, though, just for means of comparison, if we allowed ourselves to stay in like much further than where I would want to be. Okay, I'm going to change this back to plot 1 for a second, so you can see it goes from 505 to 585. Now watch what happens if we stay in this thing a really long time. So this thing is going to expire on June 21st. Let's say we stay in till let's say 3 weeks before. Okay, and let's say we take it down to June 1st. I understand it's not realistic, but I'm trying to demonstrate a point here. So here's June 1st. So we have basically 21 days to go here, the 31st here, okay? So watch what happens now. This is worth 585 now. And what I'm going to do now is I'm going to change this to plot 3. That's interesting. Why did that only go down a small amount like that? I guess it depends on what this is actually kind of good, though. To see different stocks, because McDonald's is not a momentum stock. It's really not a high flyer. It's doing the debit spread with this actually really helps to crush the time decay. And that's really just another charm of using these debit spreads. So at any rate, this is kind of the rough scenario, though, of what I would be looking at. So again, what I would be doing, and being really more realistic, if this thing gets in on, let's just say, how long would, if you actually got in and you actually got a price move, what would it take? A week, 10 days? I mean, it could happen in 3 days for all you know. But either way, I really wouldn't be in probably for this long. But this kind of gives you a rough idea of how one would do this. And then the other interesting thing, just as a matter of comparison, is if you would just look at the buying the 180. So now we're just looking at, we're actually, there we go. And one can actually look at this and say, okay, how much, if I just bought the, if I got in, just bear with me 1 second here. So here's 183 and a quarter. So why does this say 11? Oh, no, actually, why does that say that there? Oh, there we go. Oh, because this is where we are today. Sorry. Okay, so at 183 and a quarter, so this is what it's worth today. It's worth about 11.58 today. Okay, but if this thing pulls back to 183 and a quarter, then in fact we would end up spending about 775 for this option. But notice something that's very interesting. Where before we on the debit side, and this is really why I love these debit spreads. Notice right here at 183 and a quarter, if we ended up staying in to like for basically with 3 weeks left to go on this option, we would make about 70 cents on this. Watch what happens if we stay in for the same amount of time on the single option. Here we paid 7.75. Here it's worth 7.12. So in the case of the debit spread, we made 80 cents. In the case of this single option, we lost about 65 cents. Okay, this is the power of these debit spreads, and from almost every perspective, they are really just a wonderful trading instrument. They lower your break-even point. They're much more forgiving. They let you stay in the trade longer. You can see if you stay in the trade, in one sense, in one case you make money. With the single option, you lose money if you're in for a long time. They're essentially much more forgiving trades. Now, to be clear, the one thing that makes these different, and the one thing that some people don't like about them, is that essentially, I'm going to put this in baseball terms. I know that some people don't relate to baseball, but I think at least on a rudimentary basis, I think even this baseball reference should be good for even people that don't like baseball or even don't know baseball. Single options are kind of like having a shot at hitting a home run, okay? Because essentially there's unlimited reward pretty much on a single option, okay? Particularly calls. I mean, theoretically with puts, it's not unlimited because the stock can only go to zero. But for all intents and purposes, it is unlimited risk and reward on both of those. But the thing is, with the debit spread, your top side is capped. Okay, so you can only make a certain amount, which actually has to do with the difference in the strikes minus the amount that you actually pay. So if theoretically on this one, if basically, you know, if you had let's say a $15 difference between the strikes, and you pay $7.75 or $7.50, well then the most you could ever make in the trade would be $7.50. Okay, so it puts a cap on your win. But what do you get in exchange for the cap? You get exchange for the cap time decay that oftentimes is almost negligible. You can stay in the trade for a long time. There are times that you can make money with the debit spread where you actually lose a significant amount of money with the single option. And so to some degree, one has to also adjust their mentality to this. I'm very comfortable with this because this is how I support my family. I support my family as a trader, and so as a result, I'm not looking for lottery tickets. I'm not looking to hit home runs. I like to have this kind of nice, steady stream of income that kind of gets generated from various sorts of options positions. So at any rate, that's kind of a quick and dirty on kind of how I would break down McDonald's. You know, there's a couple of other elements that I would bring into this, but for the purpose of this discussion here, I hope, Byron, this kind of gives you at least an initial jumping off point. But I have to tell you though, the most important thing would really comes into play is this thing right here. knowing that how implied volatility is in order to even tell me that in fact it really makes sense. Because if I happen to have been, let's say, if implied volatility was sitting here and I was doing this options analysis here, that spread that I just showed, which was going to cost about 750, would probably cost like $10 or $11 if the implied volatility is up here. And that, of course, makes it a much more expensive, much more difficult trade, and probably a trade that actually has relatively low probability. Because if you recall what I said earlier, implied volatility tends to kind of regress to the mean. So when it's very high, a lot of times it's very high because of the fact that it's in proximity to an earnings announcement. And so as a result, if it's very high and now you've gotten past the earnings announcement, it might just collapse on you. And even if there's no earnings announcement, like I said, there is this general tendency for implied volatility to kind of regress to the mean. So I would much rather buy implied volatility when it's low, and I would much rather sell it when it's high. So at any rate, there you have it. So anyway, thank all of you guys for your attention. I know it's kind of late. It's 8:20 in the East here. But again, I wanted to thank you for your attention, and Ryan will get you the stuff out tomorrow in terms of the PowerPoint and other information that he talked about, and we look forward to seeing all you guys again soon. Anyway, thanks so much. Take care and have a good night, everybody.
Yep, have a good night, everybody. And like Mitch said, I'll send all that information out to you tomorrow and talk to everybody soon. Have a good night. Bye.